Well, we had some good news on GDP, the first positive growth this year, but it may not last because the underlying components are a little weaker than expected. 2.6% annual rate of growth in the third quarter. That's up from a 0.6% in the second quarter and a negative 1.6% in the first quarter. Consumer spending dropped off, up 1.4%. That was down. Business investment a little stronger, but a big drop in structures building held that back. Change in inventories was lower. That does subtract from GDP, but net exports is lower. The trade deficit got much narrower during the month. Exports went up, imports went down, and that means that overall that adds to growth. So what is the data telling us? Consumer spending weaker, business spending held up. Trade added 2.77% to GDP on a 2.6% GDP overall. Inventories subtracted 0.7%. Real final sales, half of what they were in the second quarter. Goods versus services shows that essentially we are recovering from the pandemic because goods spending is starting to go down. Services spending is starting to go up. And John, you mentioned some of the other areas of the economy we got numbers on today. They tell us something about what's going forward. Durable goods orders on a headline basis, okay, but core capital goods orders, basically business spending, down 0.7 in September, the last month of the quarter. And that suggests that business spending, which is one of the slightly bright spots in this GDP report, is going to slow down. Now the question is what happens to the labor market? Do we still need all those workers if we're not producing as much? Jobless claims not showing any change in the labor market for right now.